More Singaporeans are taking their health seriously but may need help with managing their wealth. A recent financial wellness survey conducted by OCBC, polling some 2,000 working adults aged 21 to 65, found that the majority of Singaporeans are not sufficiently equipped for financial emergencies. And among those surveyed, more than 70% are not on track with their retirement plans. And half of those who fall within the sandwich generation find it tough to financially support both their parents and children. Now, for more, I'm joined by the lead researcher of the survey, Nicole Foo, and Vasu Menon, Executive Director for Investment Strategy at OCBC. Thank you very much for coming in. Okay, Nicole, I want to start with you because the survey was done based on 10 pillars and 26 indicators. So break it down for us. Which are some of the pillars and indicators, in your opinion, are the most important in actually determining someone's financial wellness?
Okay, so we identified 10 pillars that define one person's financial wellness, and they include things like your saving habits, whether you have the right protection in place for financial emergencies, do you have regular investings, do you have the right retirement plans in place, do you conduct a regular review with a financial planner, if you have debts, are you managing your debts well, are you taking part in excessive speculation, do you have a gambling habit, do you spend beyond your means, and do you borrow often from your friends and family? So these are the 10 key pillars that we think identify one person's financial wellness. But when it comes to saying which one is more important, I would say all of them are quite equally important. But interestingly, we found that different age groups actually perform differently for different pillars. For example, those in the 20s, we find that they are quite good in saving up. They stick to their budget quite conscientiously. However, because of a haste to want to get an early start in their investments and building up their funds, we found that they tend to take part in quite a bit of excessive speculation. Whereas for those in their 30s, financial obligations arise, you get married, you have a house to support. So we find that they're being put in two directions. They struggle to actually balance between fulfilling these financial obligations and as well as building up their wealth. So I would say all 10 pillars are quite similar in terms of importance.
Okay, well, it's very comprehensive, these 10 pillars. So Vasu, I'm going to bring you into this conversation. In terms of financial emergencies, it says here, 42% surveyed they are on track to accumulate enough funds for an emergency. 51% can actually stretch their savings to last 6 months. So put things in perspective for us. Why is it so important to have this? And question is, how much is enough?
Well, traditionally, financial planners will tell you 6 months of your income should be set aside in an emergency fund. So emergency fund is intended for eventualities. For example, job loss. You lose your job, it's assumed that you will take 6 months to find another job. I mean, the global economies have a long cycle of expansion. We've almost 10 years of expansion. Economic prospects are uncertain. We are seeing clouds of uncertainty. Job prospects are uncertain, especially at this juncture. So investors ought to be prepared for that. If they ever lose their jobs, temporarily, hopefully, then they should have at least 6 months of their income set aside to meet their short-term obligations. Now, 6 months is the minimum. I think, if possible, you should have more than 6 months, especially in a climate like this. We are in a new normal. World economy is going through significant changes. Restructuring is taking place. Technology is quite prevalent. So I think, at least 6 months, and that's the significance of, having emergency funds.
Okay, and these emergency funds are separate from your actual saving funds we're talking about, correct?
Separate from your savings funds. They should be earmarked, set aside, only to be used for emergency.
Okay, so the index also shows that Singaporeans are not big on investing. In fact, 33%, that's 1/3. Think of investing as a form of gambling. Why is that the case, though?
Well, if you think about it, in the last 10 years, ever since the global financial crisis, we've had huge amount of market volatility, so much of uncertainties. Blue skies investing is no more there. I mean, we've gone from one crisis to another crisis. We're always, we're always facing uncertainty. So I think the market volatility has caused investors to be nervous. And so many of them are seeing the markets as a place where there's a tremendous volatility, and they see it as a gambling den. But I think, if you look at how global equity markets have done in the last 10 years, global equities have actually appreciated 220% despite that volatility. So that's roughly about 12% per annum. So despite the volatility, there were still opportunities to make money, but just that the volatility has spooked a lot of people, and they see the markets like as if it's a casino because of the volatility.
Right. Okay, Nicole, very quickly, the survey also found that women are more averse to investing. Do you guys have an explanation for that?
Well, yes, we found that 39% of us are actually more averse to investing. Well, I think traditionally, the man goes out to work and brings home the bacon, whereas the wife, being a housemaker, stays home and perhaps manages the purse strings. So I think traditionally some of that values and habits have been passed down to the later generations, and we are being taught to be more conservative, we are being taught to be more prudent and not take such an aggressive approach in terms of investments. So I suppose that could be one of the reasons. We also found that, like what Vasu had mentioned just now, the external environment is not helping much as well. So with all these fears internally as well as from the macro environment, I guess that contributes to the fact that, women in generally are quite averse to investing.
Right, so if you're just very unsure, speak to your financial planner, go to, any banks, go to OCBC, speak. There will always be someone there to help you with your investments. Thank you so much for coming in and speaking to us. We've been speaking there with Nicole Foo and Vasu Menon from OCBC Bank.